Index funds made everyone rich for 40 years, but the S&P 500 is now over 33% concentrated in technology and AI-adjacent stocks. That changes the math on everything. Welcome back to Money in the AI Era. Over the past 4 weeks, we've built a complete picture of the AI economy for people in their 30s. Week 1, whether your savings are actually on track. Week 2, why the 5-year rule for buying a house is broken. Week 3, which side hustles are dying and which ones are surviving. Week 4, which skills compound and which ones decay. All 4 of those conversations point to the same underlying question. If you're building career capital and generating income in the AI economy, where do you actually put the money? This week, we answer that. And we're going to be honest about 3 things most investing videos won't say directly. 1. Index funds are still the right foundation for most people, but the naive, just buy VOO advice now comes with hidden risk most people haven't accounted for. 2. The 401k versus Roth question has a specific answer in the AI economy that's different from the standard advice, because income predictability looks different now. 3. AI stock exposure isn't a binary choice between buy individual AI names and ignore it entirely. There's a framework for thinking about this rationally. Let's start with the concentration problem, because this is the most underappreciated risk in most people's portfolios right now. In 1990, the S&P 500 was genuinely diversified. The 10 largest companies, including IBM, Exxon, General Electric, and Philip Morris, made up about 19% of the index. No single sector dominated. Today, the top 10 holdings account for over 38% of the S&P 500. Nvidia, Microsoft, and Apple alone represent roughly 18%. Technology and AI-adjacent stocks as a group now make up over a third of the index. According to RBC Wealth Management, the top 10 stocks in 2025 represented roughly 41% of the index's total weight, but were expected to generate only about 32% of its earnings. Weight and earnings are no longer aligned. That gap is the risk. What this means practically, if you're in a standard S&P 500 index fund, you are already heavily exposed to AI. You just didn't choose that exposure. It happened passively as AI companies grew. That's not necessarily bad, but it should be a deliberate decision, not an accidental one. Now let's talk about the 401k versus Roth question, because this is where the AI economy changes the standard advice. The traditional framework is simple. If you expect to be in a higher tax bracket in retirement, do Roth now and pay taxes at your current lower rate. If you expect to be in a lower tax bracket in retirement, do traditional and get the deduction now. That framework assumes a predictable income trajectory. You start lower, you earn more over time, you peak before retirement, then you draw down. The AI economy disrupts that assumption. For people in decaying career categories, income may plateau or compress earlier than expected. For people in compounding career categories, income may grow more non-linearly, with bigger jumps and potentially higher peaks. For people building side income alongside a primary career, their income structure is more variable than a single employer trajectory. Here's what the data says for 2026. The 401k contribution limit is $24,500 per year, according to the IRS, and confirmed by Fidelity and Vanguard. The Roth IRA contribution limit is $7,500 per year for those under 50. Roth IRA eligibility phases out between $153,000 and $168,000 for single filers, and between $242,000 and $252,000 for married couples filing jointly, according to the IRS. For most people in their 30s, earning between $60,000 and $150,000, the honest framework for the AI economy looks like this. First, always contribute enough to your 401k to capture the full employer match. That's an immediate 100% return on that portion of your money. There is no argument against this step, regardless of your tax situation. Second, If you are in a decaying career category and your income may compress in the future, traditional 401k contributions may make more sense because your future tax rate in retirement could be lower. Third, if you are in a compounding career category and you expect your income to grow meaningfully, Roth contributions favor you because you're locking in today's tax rate before future income growth pushes you into a higher bracket. Fourth, if your income is variable because you're building side income alongside primary employment, a Roth IRA up to the contribution limit gives you more flexibility because Roth contributions can be withdrawn penalty-free at any time, unlike earnings. This is not financial advice for your specific situation. Tax circumstances vary significantly, and you should work with a qualified financial planner for decisions at this scale. What I'm giving you is the framework, not the prescription. Now let's talk about AI stock exposure specifically, because this is the question that divides people most sharply. On one side, people saying AI is the biggest investment opportunity of a generation, buy NVIDIA and MSFT directly. On the other side, people saying individual stock picking is gambling, stick to index funds. Both positions miss the nuance. Here's the actual spectrum of AI exposure you can have in a portfolio, from lowest to highest concentration. The standard S&P 500 index fund. As we discussed, you're already over 33% in technology and AI-adjacent companies. You have significant AI exposure whether you wanted it or not. Equal weight S&P 500 fund. This is one practical response to the concentration problem. An equal weight version allocates roughly 0.2% to each of the 500 companies rather than weighting by market cap. You reduce your AI concentration significantly at the cost of giving up some of the return that concentration generated over the past 3 years. Broad Technology Index Fund, something like QQQ or a total technology sector fund. You're now explicitly choosing higher tech concentration than the market cap S&P, but across a broad basket of technology companies rather than individual names. AI-specific thematic ETF. Funds like BOTZ or ROBO that focus specifically on AI, robotics, and automation companies. Higher volatility, higher concentration, explicitly a bet on AI category growth rather than individual company success. Individual AI company stocks, NVIDIA, Microsoft, Alphabet, Meta, and others. Highest concentration, highest potential return in a continued AI boom. Highest risk if the boom plateaus or specific companies underperform. There is no correct answer for where on that spectrum you should sit. That depends entirely on your time horizon, your income stability, and your ability to stomach volatility without panic selling. What I will say is this: the one mistake that is almost universally wrong is accidentally sitting at the high end of that spectrum without realizing it. If you're in a standard S&P index fund and a tech-heavy 401k target date fund from the early 2000s vintage and a QQQ position you bought during COVID, you may be more AI concentrated than you know. Audit the aggregate before you add anything. 3 moves this week. Move 1. Look at your current 401k and IRA allocation and add up your actual technology and AI-adjacent exposure across all funds. Most brokerage platforms can show this breakdown by sector. Get the real number. Move 2. Decide whether your current AI exposure is intentional or accidental. If it's higher than 35% of your total equity allocation, ask yourself whether you've made that bet deliberately. Move 3. Revisit your Roth versus traditional split based on your career category. If you're in a compounding skill category with growing income potential, weight toward Roth. If your income is likely to compress or plateau, traditional contributions may work in your favor. And one final framing that ties all of this back to the series. Your portfolio is downstream of your career. The best investment decision you can make in your 30s is building the career capital that generates the income that funds the portfolio. The asset allocation conversation only matters if you have something to allocate. The people who navigate the next decade well are not the ones who made the perfect AI stock pick. They're the ones who correctly identified their career category, built the right side income, developed compounding skills, and then invested consistently in a framework they actually understood and could stick with through volatility. That's the honest math. Next week, we're answering the question that sits underneath all of this. If you're building a portfolio in your 30s right now, should you prioritize equities or real estate? We're going to run the actual math on both. Look at what the AI economy does to each asset class and give you a framework for making that decision based on your specific situation, rather than the standard advice. If you want that, subscribe so you don't miss it. In the description below, every source cited today is linked. IRS 2026 contribution limits. RBC Wealth Management on S&P concentration. Fidelity and Vanguard on 401k and Roth IRA rules. Check the work. See you next week.